Hi, this is Catherine Neal, and in this lecture we're going to look at the Sarbanes-Oxley Act of 2002. The Sarbanes-Oxley Act, which is commonly known as SOX, S-O-X, was a huge piece of legislation enacted by the United States Congress and signed into law by President George W. Bush on July 30th, 2002. This law came into being as a result of a huge wave of corporate scandals that happened in the United States in the early 2000s. These were huge, costly, high-profile scandals that resulted in, at the time, the largest bankruptcies in the history of the United States, and included scandals like the one at Enron, at WorldCom, at HealthSouth, at Tyco, and other corporate scandals. The United States Congress felt pressured from the public, from investors, from the general public, to take some action in response to unethical and illegal behavior by the leaders of some of the largest corporations in the country at the time. And so Sarbanes-Oxley was what they came up with in response to these scandals. And if you look at the different provisions, which we will do, you can see where they were drafted in direct response to some of the things that happened in these corporate scandals. So, what is the Sarbanes-Oxley Act? Here's a short video.
The Sarbanes-Oxley Act of 2002 is a legislative response to a number of corporate scandals that sent shockwaves through the world financial markets. Some of the biggest issues involved Enron, Tyco, and WorldCom. The Sarbanes-Oxley Act, commonly referred to as SOX, attempts to strengthen corporate oversight and improve internal corporate control. The main purpose of SOX is to protect shareholders from fraudulent representations in corporate financial statements. Investors need to know that the financial information they rely on is truthful and that an independent third party has verified its accuracy. SOX is a long and complicated law, but it has a few key provisions. Section 302 requires that corporate management certify that they have reviewed the financial statements and that they are accurate and truthful. Section 401 requires that financial information include disclosures about any relevant off-balance sheet obligations that may exist. Section 404 requires management to state whether or not the company's internal control procedures are adequate and effective. Section 404 has costly implications for publicly traded companies, as it is expensive to establish and maintain the required internal controls. Section 409 requires management to update the public of significant financial matters when they happen, rather than wait until the quarterly or annual report. Section 802 imposes penalties for violations of the SOX rules, which can include fines or even jail time.
The Sarbanes-Oxley Act was the largest piece of legislation enacted that impacted corporate America since the Securities Acts of 1933 and 1934. So it is not often that the United States Congress steps in and legislates the things that businesses can and can't do and must do. So this is an unusual action on behalf of the United States Congress. And the impact was significant. Now, this act applies only to publicly traded corporations. It does not apply to privately held corporations. If you don't understand the difference, please review the article linked in this PowerPoint presentation to make sure that you understand the difference between a publicly traded and a privately held corporation. A brief explanation is that all corporations issue stock by their very nature. That is the nature of a corporation. And a share of stock represents a piece of ownership in the corporation. You can own a single share of stock, you can own millions of shares of stock. And corporations can issue as few as one share of stock or have millions of shares of stock outstanding. The difference between publicly traded and privately held is that if a corporation is privately held, a limited number of people or groups are able to own the stock of that corporation. The rest of us don't have the ability to go and buy shares of stock of a privately held corporation. It's limited to a few individuals, a family, smaller groups. We don't have the right or the ability to go buy shares of stock of that corporation on the stock exchange, as compared to a publicly traded corporation where any investor that has enough money can go buy shares of stock on a stock exchange or in an over-the-counter market. So that's the difference between a publicly traded and a privately held corporation. The reason that this law and many, many other laws apply only to publicly traded corporation is that the government takes an interest in protecting investors, in protecting the public. So if a company is going to sell its shares of stock to the public, the government wants to make sure that those individuals, those investors, are protected, requiring certain types of information be provided to investors before they invest or after they have invested, financial information and other information, to make sure that investors are protected from fraudulent actions of leadership of the corporation. And it's a long, long list of laws, and one of those is the Sarbanes-Oxley Act. So that's why it applies to publicly traded corporations and not privately held corporations. And the stated purpose of SOX is that an act to protect investors by improving the accuracy and reliability of corporate disclosures made pursuant to the securities laws and for other purposes. The act was signed into law by President George W. Bush, who at the time of signing it made a few key statements that reflect how the public and how investors viewed corporate America at the time. He called this the most far-reaching reforms of American business practices since the time of Franklin D. Roosevelt. He said, "No more easy money for corporate criminals, just hard time." And President Bush also said, "The era of low standards and false profits is over. No boardroom in America is above or beyond the law." And again, statements that reflect the mood at the time and the anger that existed toward corporate executives as a result of all of the major corporate scandals. The law itself, the text of the actual law, is complex and lengthy. If you're interested in looking at it or any particular provisions, it's available online, soxlaw.com. So take a look if you're interested in the actual language of the law. Now let's take a look at some of the key provisions of the Sarbanes-Oxley Act. The first one we're going to look at is the creation of the PCAOB. PCAOB stands for Public Company Accounting Oversight Board. This is a quasi-governmental entity that establishes significant oversight over the accounting profession. For the first time ever in the history of American business practices, the federal government stepped in and decided that the accounting profession had to have oversight because the accounting profession failed in its duties during these major corporate scandals. The accounting profession, and particularly CPAs, or certified public accountants, are charged with auditing the financial statements of publicly traded corporations. Publicly traded corporations are required to file financial statements with the SEC, the Securities and Exchange Commission, annually and quarterly. The financial statements must be audited by a certified public accountant. So we have long looked at the accounting profession and CPAs as a safety net to make sure that the financial information given to us by publicly traded corporations is accurate and that we can rely on it, that the information accurately reflects the financial condition of the corporation. During these major corporate scandals, the accounting profession failed to point out huge flaws in accounting practices, in the numbers that were included in financial statements for companies like Enron and WorldCom, where their financial statements in no way accurately reflected the financial condition of the company. So for that reason, the United States Congress stepped in and said, okay, we're not going to trust CPAs anymore to do their job without oversight. And they created the Public Company Accounting Oversight Board, or the PCAOB. This board is under the direction of the SEC. It oversees audits of public companies. It establishes audit report standards and rules. It investigates, inspects, and enforces compliance. A big part of this provision is that all public accounting firms that perform audits on publicly traded corporations must register with the PCAOB, something that never happened before the Sarbanes-Oxley Act was passed. The PCAOB has the power to discipline public accounting firms. This provision gives the SEC the authority to determine GAAP. GAAP is generally accepted accounting principles. This function was previously controlled solely by the accounting profession. PCAOB has its own website where there's plentiful amounts of information available if you're interested or need that information for any reason. So the website is pcaobus.org. And here's a short video about the PCAOB.
Known as the PCAOB. So the PCAOB is a nonprofit corporation that was created by United States Congress in 2002. And it was actually part of the Sarbanes-Oxley Act. So the Sarbanes-Oxley Act was passed in response to a wave of accounting frauds from U.S. companies like Enron and WorldCom. And so Sarbanes-Oxley did a lot of things to tighten up regulation for firms and also for the audit industry, but it also created this PCAOB to serve as a watchdog or regulator of the audit industry. So auditing firms previously had been self-regulated, but now what Congress did is said, okay, look, we had a major audit failure here with Arthur Andersen and their audit of Enron and so forth. So now we're going to create this PCAOB, and they're going to make sure that the auditing industry is doing a good job, that auditors are maintaining their independence, and so forth. So I want to tell you a little bit of structure of the PCAOB, and then we'll talk about the role. So there are 5 board members on the PCAOB, and one of the people serves as the chairperson. So there's 4 regular board members, and then the board member who's the chairperson, and they're appointed by the Securities and Exchange Commission. So it's interesting that even though it's a nonprofit corporation, the PCAOB, and it's an independent group, it's tied to this public agency. is tied to this public agency, and by public I mean governmental, because the SEC is a governmental agency, right? And so a governmental agency is appointing the members of the PCAOB. So sometimes people call it PCAOB a quasi-governmental entity, but it's not technically a government agency. Okay, and these board members, they're going to serve 5-year terms. And the SEC also is going to oversee the activities of the PCAOB. They're going to approve their budget, their activities, and so forth. So the SEC is closely involved with the activities of the PCAOB. Now, the PCAOB, in terms of their funding, they get money from fees that are paid by public companies. And when I say public companies, I mean companies that are publicly traded. Because, again, the PCAOB has to do with audits of public companies, companies that you could buy their stock on a U.S. stock exchange, right? It's not talking about small mom and pop businesses that have a local CPA do the audit, right? So this is large firms that are publicly traded, and we're regulating the auditors that audit those public companies. Now, in terms of the role, there are multiple things that the PCAOB does. So just to give you kind of a summary, one thing is that, first off, all companies that are doing an audit of a publicly traded firm of one or more, they have to be registered with the PCAOB. So they have to register with the PCAOB, and that's going to be important for a number of reasons, which I'll talk about in a moment. Now, the PCAOB also is the standard setter for the auditing industry. Now, when I say standard setting, you might think about the FASB and think about GAAP. That's not what I'm talking about. I'm talking about auditing standards, right? GAAP is accounting standards for how we should be doing accounting. But we also have generally accepted auditing standards. We have these auditing standards that are made about how to properly do an audit. And so the PCAOB, they have that responsibility. So they not only, firms have to register with the PCAOB, they have to follow the rules, the standards that the PCAOB sets of how to properly conduct an audit. Now, I had said that these firms, they register with the PCAOB, and that's important because the PCAOB is going to monitor these audit firms on an ongoing basis. So if we've got a firm that's auditing publicly traded companies, the PCAOB is going to go in they're going to sample, they're actually going to go and sample some of their audits. They're going to do a sample and say, hey, let's take a look at one of your audits and see if you're actually following the auditing standards, if you're doing a good job. So actually the PCAOB has a role of ensuring quality control, to go in and make sure that the audits are up to par. And then the PCAOB also have a role with enforcement, discipline, and sanction. So if they go and they monitor and they find out that, you know what, we took a look at one of your company's audits and we're really not happy with what happened, they can go and they can actually initiate disciplinary proceedings and impose some kind of penalty or sanction against that audit firm. So the PCAOB has a lot of power, and their role is basically the watchdog or the regulator for the auditing industry.
The next provision of the Sarbanes-Oxley Act that we're going to look at is auditor independence. This is basically an ethics rule book for public accounting firms. Again, the government stepping in and providing more oversight of the accounting profession. This particular provision prevents conflicts of interest by prohibiting dual relationships between auditors and their audit clients. Now, this provision was included in the Sarbanes-Oxley Act as a direct response to the Enron scandal and the relationship between Enron and its auditor, Arthur Andersen. And a quote from Chief Justice Warren Burger explains this provision. By certifying the public reports that collectively depict a corporation's financial status, the independent auditor assumes a public responsibility transcending any employment relationship with the client. The independent public accountant performing this special function owes ultimate allegiance to the corporation's creditors and stockholders, as well as to the investing public. This public watchdog function demands that the accountant maintain total independence from the client at all times and requires complete fidelity to the public trust. And this is where the accounting profession let us all down as related to those large corporate scandals. Their fidelity was to their clients more than to the investing public or to shareholders or creditors. So this part of the Sarbanes-Oxley Act seeks to prohibit relationships that could lead to problems in performing an independent audit. The relationship between Enron and Arthur Andersen is a perfect example of these types of problems. Enron managers used questionable accounting practices to inflate the value of assets and hide liabilities. This resulted in misleading financial statements and overvalued stock, which the managers conveniently sold before their fraudulent activities were exposed. Enron managers got the ideas for some of their most creative accounting practices from the consulting arm of Arthur Andersen. This is at the same time that Arthur Andersen was performing audits on Enron's financial statements. Enron purchased $1 million of consulting services a week from Arthur Andersen, in addition to the audit fees that they were paying Arthur Andersen. So this type of conflict of interest was problematic in that the auditors from Arthur Andersen found it difficult or risky to point out problems in the financial statements and problems with Enron's accounting practices because they didn't want to lose that $1 million a week of revenue they were receiving from Enron for consulting services. It's this type of relationship that Sarbanes-Oxley now prohibits. There was a clear conflict of interest. Andersen auditors had incentives to ignore questionable accounting practices at Enron to maintain the lucrative stream of revenue that was coming in to Arthur Andersen from Enron. Under the Sarbanes-Oxley Act, accounting firms that audit publicly traded corporations may not also perform the following consulting services: bookkeeping and other services, design and implementation of financial information systems, appraisal and valuation services, fairness opinions, actuarial services, internal audit outsourcing services, management functions and human resources, and you can see the complete list there on the screen. So this law seeks to put an end to the types of relationships where a conflict of interest develops and auditors can no longer perform their function independently. And so now you can't have these types of dual relationships between an auditor and an audit client. The next provision of Sarbanes-Oxley Act I want to look at is audit committees and how they are now regulated by the Sarbanes-Oxley Act. Audit committees are a subcommittee of a corporation's board of directors. The function of the audit committee is to hire and oversee the CPA firm responsible for conducting the independent audit. Under the Sarbanes-Oxley Act, all members of the audit committee must be members of the company's board of directors, and they must be independent directors. And independent is defined as be an outside board member, which means they're not an officer or employee of the company, have not been an officer for a given period of time, do not have close relatives working in management of the company, and do not have any contractual or consulting ties to the company, so that they can, again, provide service without a conflict of interest. There's a visual representation of a board and the subcommittees of a board one of which is the Audit Committee. The next provision of the Sarbanes-Oxley Act that I want to touch on is the provision that now requires that the CEO and CFO of a corporation certify financial statements. These are the financial statements that are filed with the SEC, a requirement of securities laws that these financial statements be filed. Before they are filed, both the CEO and CFO must certify that they're accurate. If later it turns out that those financial statements were not accurate and the CEO and CFO received any type of bonus based on the numbers provided in those financial statements, they have to give up those bonuses. It's called a clawback provision. So they forfeit any bonuses and compensation based on inaccurate financial statements. Now, this provision is in place because often in these large corporate scandals, the CEO and CFO would claim that they had no knowledge of the fraudulent behavior going on in the company and reflected in the company's financial statements. Say, I'm the CEO, I have nothing to do with putting together those financial statements. I didn't know they were inaccurate. I just hire good people and expect them to do their job correctly, so you can't blame me for fraudulent financial statements. Well, now, under Sarbanes-Oxley, the CEO and the CFO are held personally responsible for the accuracy of the financial statements. They can no longer claim ignorance about what's going on. They have to know what's going on. The next provision of the Sarbanes-Oxley Act that we're going to look at is one that requires enhanced financial disclosures. This is just an addition to the number of things that companies must disclose in their financial statements. This is primarily in response to the Enron scandal and the company's use of SPEs, or special purpose entities, that at the time were not required to be reflected in the company's financial statements. So this provision gives investors and potential investors, creditors, suppliers, anyone who deals with the corporation and relies on the financial information included in their financial statements, gives them better information, more information. Also, in direct response to, I believe, the Tyco scandal and others, corporations can no longer make personal loans to corporate executives. Back in the 1990s and the 1980s, one of the big perks of being an executive level employee at many corporations was that the corporation would make loans to you, sizable loans at low or no interest rates. This provision of the Sarbanes-Oxley Act now prohibits those types of loans. The Sarbanes-Oxley Act requires that corporations develop a separate code of ethics for senior financial officers. Section 404 of the Sarbanes-Oxley Act was one of the ones that corporations were most anxious about when this law was first enacted, because it was expensive to comply with it. 404 requires internal controls for assuring the accuracy of financial reports and disclosures, and it mandates that internal controls are audited. So this had to do with accounting systems and audits of accounting systems, and it was quite expensive for many corporations to comply with this section of the law. This section of the Sarbanes-Oxley Act also requires that every audit committee have at least one member who is a financial expert. So someone who can actually look at financial statements and work with auditors and know exactly what they're talking about. Another important provision of the Sarbanes-Oxley Act deals with conflicts of interest between analysts and the corporation. A stock analyst is someone who studies corporations and gives advice about when to buy or hold or sell shares of stock based on the company's performance and anticipated performance. In many cases, in some of the large corporate scandals that happened in the early 2000s, there were inappropriate relationships between companies and the individuals who were serving as analysts for those companies, so that their analysis of the company stock was tainted by gifts, special favors, conflicts of interest between the corporation and the firms with which they are involved. So this provision helps to alleviate those types of relationships. One of the important things that SOX did was increase the types of criminal penalties available to prosecute bad actors in corporations, so leaders who committed fraud or other crimes, and to increase the penalties if individuals were tried and convicted under those laws. So it gave prosecutors more teeth, more ability to go after white-collar criminals. The law recommended stronger sentencing guidelines and specifically adds failure to certify financial reports as a criminal offense. So the CEO and CFO must certify financial reports, otherwise it's a crime. So you might be asking yourself whether or not the Sarbanes-Oxley Act was effective. Is it effective to pass laws that force people to behave ethically under penalty of going to jail or paying sizable fines? There are a couple of articles linked in this PowerPoint. The first one is a New York Times article, and a quote from that article says, "Has Sarbanes-Oxley failed? Not at all. The law has made an enormous difference, but not in the way you might think. The impact of Sarbanes-Oxley isn't necessarily found in the collective impact of its substantive provisions. Rather, it is found in the profound way the law has reshaped attitudes toward corporate governance." Another article published by the PCAOB said it restored investor confidence, which was the goal of the act. So take a look at those articles and give it some thought. Do you think that this type of legislation, where we force people to make ethical decisions, do you think it's effective?